Stop what you're doing and hear this. February 8th, 2026 could become one of those "I wish I paid attention" dates, because Japan, yes Japan, might make a decision that ripples through the US dollar, US stocks, mortgage rates, crypto, and even your cost of living. And here's the wild part. This isn't about Japan being a small side story in global markets. Japan is sitting on a financial lever so big that if it moves even slightly, it can shake the entire system. So today I'm going to break this down in plain English. Why Japan's bond market matters to you, what the yen carry trade really is, and why it's a hidden fuel for markets, why Japan owning US debt is a bigger deal than most people realize, and the 3 possible outcomes after February 8th. Plus, what to watch next. Stay to the end, because the last section is the part most people miss, and it's the part that decides whether this becomes a slow grind or a sudden shock. To understand what's coming, you need to understand how Japan got here. Most countries spend years fighting inflation, prices rising because the currency buys less, but Japan, for decades Japan battled the opposite monster, deflation. Deflation means prices fall over time, and at first glance deflation sounds like a good thing. Wow, my money buys more. But here's the trap. When prices keep falling, people delay purchases, businesses struggle to raise revenue, wages stagnate, and the whole economy slows down like a car running out of fuel. So Japan did what modern governments do when growth stalls. They stimulated. Hard. Now, let's talk about one of the weirdest experiments in modern finance, negative interest rates. Most people understand normal interest rates. You lend $1,000, you get paid back $1,000 plus interest. Negative rates flip the script. You lend $1,000, and you get back less. It sounds insane, right? So why would anyone agree to that? 2 reasons. Reason number 1, if you think every other option is worse, losing a little might feel safer than losing a lot. Reason number 2, the big one. Japan's central bank, the Bank of Japan, was effectively the government's best friend and biggest helper. When your central bank is willing to buy your debt, keep rates ultra low, and support the system, the government can run stimulus for a long time. And they did. But here's the problem. Stimulus has a price, and now the bill is coming due. Japan is no longer stuck in deflation land. Now Japan has inflation pressure, and when inflation shows up, everything changes, because inflation forces a painful question. Do we keep stimulating and printing, or do we tighten up and protect the currency? That's why February 8th matters. Because Japan is facing a decision point where the wrong move can break something, either break growth or break stability. Now let's connect Japan's decision to the US. This is where it gets serious. There's a concept that quietly pumps money into global assets, especially US assets. It's called the yen carry trade. Here's the simple version. Japan has had some of the lowest interest rates on earth. Big institutions borrow Japanese yen cheaply, sometimes almost free. Then, they convert the borrowed yen into other currencies and buy assets like US stocks, US real estate, crypto, anything that can return more than the cost of borrowing. So if you borrow at near 0% and you earn 6% elsewhere, that spread becomes the easy money strategy. And this matters because it's been a major source of liquidity supporting markets in recent years. Now imagine Japan shifts policy. If Japan raises rates or pulls back stimulus, borrowing cheap yen becomes harder. And when that happens, some of that easy money can stop flowing into US assets. Even worse, some of it may unwind, and an unwind can be violent, because when a carry trade reverses, it can force selling fast. Now here's a detail that should make you pay attention. A huge share of Japanese mortgages are variable rate, meaning when interest rates rise, monthly payments rise, and if payments rise faster than incomes, you get stress defaults, forced sales, and in extreme cases, a housing and credit problem. We've seen what variable rate pressure can do before. Different country, same concept. If Japan is trying to manage inflation while avoiding financial stress at home, that's a tightrope walk. And if they slip, or den one, deidserm efter den stenstersen, and denser dester mal det stanver, jau dender jenscher gens, all denshurk, doesn't stay in Japan, because global markets are connected like dominoes. Now let's get to the second major connection, Japan and US Treasuries. Japan is one of the largest foreign owners of U.S. government debt, roughly $1.2 trillion in U.S. Treasuries, according to commonly cited figures in market commentary. Why does Japan buy U.S. debt? Because, for a long time, Japan's rates were so low that U.S. yields looked attractive in comparison. But if Japan's rates rise, Japanese investors may say, why take currency risk and U.S. uncertainty when we can now get decent yield at home? And that creates a big concern. If fewer buyers show up for U.S. debt, the U.S. may need to offer higher yields to attract lenders. And U.S. Treasury yields aren't just some Wall Street number. They're a baseline that influences mortgage rates, car loans, credit card APR, business borrowing, and government interest costs. So Japan shifting can indirectly change the price of money in America. That's the global ripple. So the market is watching Japan because Japan affects the U.S. through three channels: carry trade liquidity, money flowing into risk assets, treasury demand, buyers of U.S. government debt, global confidence, financial stability in a major economy. And remember, Japan is also dealing with extreme debt levels. Japan's debt to GDP has been discussed around 240% in many macro conversations. Very high. That doesn't mean collapse is guaranteed, but it does mean Japan has less room for mistakes. Now, let's talk about what this means for you, practically. If you're an investor or you're just trying to protect your household finances, here's the playbook. First, watch yields and currency moves. If U.S. yields spike or the yen moves sharply, that can signal stress or a rapid unwind. Second, expect volatility. When big macro trades unwind, markets don't move smoothly, they move in bursts. Third, don't get hypnotized by one asset. In fast-changing regimes, concentration is danger. Now I'm not here to tell you what to buy, but I'm here to tell you this. When policy changes and liquidity shifts, the people who win are the ones who understand the game, manage risk, and don't panic react to headlines. Here are three possible outcomes and what each could mean. Scenario 1. More printing, more stimulus. If Japan pushes for more stimulus, markets might initially treat it like fuel. Risk assets could bounce, liquidity could stay loose, but the risk is inflation and currency pressure, building over time. Scenario 2. Tightening, higher rates. If Japan leans toward tightening, carry trades get less attractive, capital may rotate back into Japan, U.S. yields could face upward pressure. This scenario can bring a sharper shock to global markets. Scenario 3. Mixed, slow transition. This is the manage expectations path. Smaller steps, slower changes, more careful communication. This could reduce immediate panic, but still create rolling volatility. So what should you do with this information? You don't need to predict perfectly. You just need to be aware that Japan is a hidden hinge of global finance, and February 8th is a hinge moment. Let me leave you with this. People think the world runs on headlines, but markets run on liquidity, interest rates, and confidence. Japan touches all three, so don't ignore February 8th. Watch it, track the reactions, and stay sharp, because when the bond market moves, everything moves. If you got value from this breakdown, hit the like button. It helps this channel reach more people who need simple, real-world macro clarity. And subscribe to Express Econ Geo Finance Insights, because we track the global money system in a way that actually makes sense. And I want to hear from you in the comments. Do you think Japan goes more printing or more tightening after February 8th? And why? Drop your take below. See you in the next one.